Remind yourself that over 70% of the earnings of the FTSE 100 come from overseas. So you buy the world on a discount when you buy the UK as well. So there are lots of reasons to be cheerful.
Welcome to Heart of Wealth, your weekly pulse check on the wealth industry. I'm Will Robbins, your host for this week. Today on the show, is Cool Britannia coming back? We go from the footy to the FTSE. We talk wealth building on a budget with investing from £1. And the UK regulator tells Citywire the conversation about risk needs to change. Joining me today are two Citywire journalists, Dylan Lobo and Charles Walmsley, plus special guest Piers Hillier, Chief Investment Officer of Jupiter Asset Management. Welcome.
Hello. Great to be here, Will.
Yeah. It's great to have
Thanks
you.
for inviting me.
Come a long way, Dylan.
You've come a long way. Now, first, England fans might have been left disappointed by the World Cup, but third place was the best result in 60 years. And we have a new Prime Minister, champion of Manchester, music fan, Andy Burnham. Is there cause for optimism about the UK? Now, Piers, I'm going to come to you first on this. How investable is the UK right now?
Yeah, I think it's a great time to ask that question. When you get a change in government, markets abhor a vacuum, and we've had a vacuum to a degree with a transition from Keir Starmer through to Andy Burnham. So we're now starting to look forward. So for us as investors, both from an equity but particularly from a fixed income perspective, there's been a great uncertainty about the control and discipline around government spending, and that's really meant that long bond yields in the UK, so I'm really talking 25 years plus, are really abnormally high against either our European peers or against the US. So if we maintain the fiscal discipline that Rachel Reeves talked about, I think if the government actually talks about how we might invest for growth, and it's really clear it is directed towards growth, that's the secret, then actually I think international investors will start to come back and look not only at the UK government bond market, but particularly the UK equity market. Now look, I should say one final thing is international investors have been looking at the UK market. They've been buying our companies, throughout this year. I mean, we've just had again this morning, an EasyJet. There's a ding-dong battle going on there. You've got Segro being bid for. Had Tate & Lyle earlier this year. I won't go on, but the point being is the world sees the UK equity market in particular as being great value. We need, with the government's help, to really encourage domestic investment into our own marketplace. Reward growth into the UK economy. Now, I think that message is being grasped, and certainly to your allusion around the FCA, we're waking up to understand actually why we need to take a little bit more risk for long-term returns.
It's interesting you mentioned EasyJet, Segro there, because those are take-private deals. How does that affect you from a UK equity manager perspective? Because the pool seems to be shrinking of the actual listed companies you can buy.
It's certainly true, and I think this has been a theme really for 2 to 2.5 years, and there's I can think of at least 25 companies that have been purchased by international investors, a combination of private and public companies buying, and I don't see that trend changing. So the reality is that how do we make the UK more attractive? Is we make incentive for domestic investors to increase their allocation to UK equities. I think the thing that shocks me, if you look at G10 in the world, we have the lowest allocation to domestic equities, bar none. And it's not by 5%, it's by 20%. So the average DC pension plan in the UK has less than 3% invested in UK equity, domestic market. France, who's not really got an equity culture at all, is over 30%. Germany, north of that. Italy, north of that. The US, almost 65% of their long-term savings is in their own domestic market. Australia, 45%. So my point being is there's a self-help story here that actually if the government incentivises us to invest domestically, we really could start to see that return. And that capital formation into the UK market would actually then encourage companies to want to come and list in the UK because they can access capital.
The UK is quite a boring market. In terms of the old value, you've got all these great stories out in the US. You're smoking. You don't think it's that boring,
how is it boring when we get this many bids for companies? Yeah. I'm genuinely serious.
I will come on to that.
Dull and worthy sometimes actually wins the race. My point is genuinely this: is that people aren't buying companies in the UK because we're a charity case or something. There's great value to be had. There's good businesses to be had there.
It's interesting. So if you go back 20 years, it was a core investment. Now it's a tactical investment. The UK has gone from a core market to a tactical a tactical investment, and you look at the Quilters, your Rathbones, they have the UK in their tactical bucket. And one wealth manager actually said to me, the UK is a defensive play now. It's become, which kind of makes sense. And it's still, we should not forget that the UK is still a very high yielding market. And if you want a bit of income, where else are you going to go?
Remind yourself that over 70% of the earnings of the FTSE 100 come from overseas. So you buy the world on a discount when you buy the UK as well. So there are lots of reasons to be cheerful.
We'll move on to our second story. Price comparison website Money Supermarket has entered the investment platform market, offering a suite of 40 products from leading index and ETF providers. Dylan, this was your story. Tell us what is happening and why it's important.
Yeah, big story. So Money Supermarket, the site that consumers normally go to, to switch energy provider or switch car insurance, is now entering the DIY platform market, taking on the likes of Hargreaves Lansdown and AJ Bell. It's using tech firm Seckle to build a platform, and this platform fee is pretty cheap compared to some of the incumbents at 0.34%, no trading costs. Clients who use the Money Supermarket platform will have access to 40 funds, including the Life Strategy, Vanguard Life Strategy funds. But what was really interesting is the rest of the funds are either index or passive. So what Money Supermarket is effectively saying here is that passive index is the only game in town. And I get it, that helps them keep prices down. But there are a lot of implications, a lot of interest in things that have come from this launch.
I think that comes to what Piers was saying about getting more people investing, right? And I mean, how do you see these kind of launches?
To my mind, in some ways, what's slightly disappointing is that by only offering you one choice, doesn't actually really differentiate them. So I can find, and I do, use different platforms that are on lower fees than that, and I've got other platforms that give me more choice. So yes, it's a starting point for them, and it's pleasing that we're trying to encourage people to think about investing. But is it a category killer that's going to eat my lunch? The answer is I don't think so. I still think the battle we've got to win is not starting the conversation about price. It's about return. Right? Because actually, if you get a reasonable return, we should be not unhappy then to pay an appropriate price. And if we don't get a reasonable return, price adjusts accordingly. So for most of the last 20 years, essentially we start off with price as the first consideration. We've then talked about risk, how much risk are you taking? We're almost trying to incentivize you to take as little risk as possible, which I think from a longer term 30-year perspective is crazy. And then the next tier down is, well, what's about liquidity? You've got to be able to generate liquidity, because today's the day I decided to switch my pension, having done nothing about it for 25 years. It looks like an ISA. It's not a long-term savings product. And then the fourth one is return. Well, if I go to Australia and I ask them the question about what's the obligation around super funds, real return is the primary objective. Thereafter, they want to look about the risk budget you're spending, and they do look at them. Price is obviously an important consideration as well. But we've spent far too long talking about price and not about return. And if you look about returns to underlying UK investors, it's been really disappointing, because essentially we have not deployed, whereas you compare our US cousins, Australian cousins, etc., they've been doing the opposite.
Our final story carries this intriguing headline. FCA, that's the UK regulator if you didn't know, FCA to secret PE consolidator. We agree, risk conversation must change. Charles, UK editor. Let's start with the background first of what this story is, where it came from.
Yes, so this all comes from a column written by our great columnist, the secret PE consolidator.
PE meaning?
Private equity.
Right.
Now, they are a very experienced investor. They've been writing for us for the past year about what they are looking for with buying advice firms in the sector. A few weeks ago, they published a column with the slightly provocative headline, "The FCA is the reason why we don't take enough risk." Now, I think the FCA saw this. They wanted to respond. That column was a really interesting one in that it chimed a lot with what we'd heard from the industry about where they were worried about the FCA. They feel that there is a sense that there is too much focus on the negative, too much focus on risk warnings, the famous phrase, what is it, your investments can go down as well as up. That seems to stick in people's minds.
So they replied with a letter that you've published, that we've published, essentially saying that we agree people should be taking a bit more risk.
Yes, basically saying, not in so many words, but we think it's a little bit unfair that you sort of put this on our door. We have changed our approach, and I think that is fair from them. I think in the last few years, and to be fair, our columnists did say in that piece, yes, the FCA has been better in the last few years. They have been working with industry. They now have this growth mandate as well. And the FCA, I think, was really good at talking about what they want to see. They want to protect consumers, but they also want investors to get the best outcome.
Yeah.
And part of protecting consumers is don't hold all your money in cash.
Yeah. So all the same, a very rare communication and intervention from the FCA.
Yeah. So look, and I think you make a really important point there, is that investment should be about diversification. I think it's a really important point to bear in mind. We seem to have in this perspective at the moment is either A or B. It's either in cash or is in wildly speculative stuff. And I think we're trying to drive at here is to say, look, there's actually the winning strategy probably is somewhere in the middle ground. But the most important thing is ultimately I ask myself the question day in, day out as a CIO, what's my client, my customer's problem? How do I help them solve it? And the answer normally is with the degree of a balanced fund, with a range of combination of investments, and then trying to take a longer term time horizon. Trying to pick a bottom or pick a top. I've been doing this for over 30 years. It's really, really hard to do.
That is all we have time for. So a massive thank you to our production team and to our guests, Piers Hillier, Dylan Lobo and Charles Walmsley. Thank you for watching, and we'll see you next week.